Okay, it's 12:30. Thank you very much for attending today's webinar. My name is Jasper Lawler, work here at LCG, and today's topic is how to trade the FTSE. I'm assuming everyone's read through the risk warning at this point. General idea here is if you have questions at any point, certainly feel free to ask. I'll answer as soon as I can or towards the end, or if you're posting a comment on the video on YouTube or social, we'll obviously respond as soon as we can. Topics covered for today, just a little bit about the FTSE, the history of it, not too much, but just good to know. How the index is designed, weighted and calculated, the top components and important sectors. This is important, obviously there's company news all the time, certain sectors moving in and out of favour, that can favour certain indices over others. So it's good to know what are the big players that are moving the index more than others. The fundamentals that impact the FTSE and the effect of the British pound. Big swings in the British pound, particularly since Brexit, have effect on the FTSE. It's not the most straightforward correlation, but certainly there is a relationship there. And then lastly, we'll just look at the UK 100, which is the CFD or the spread bet that you can use on the LCG Trader platform to easily trade the FTSE 100 as an index. So it is one of the most important global equity benchmarks to follow, when you're judging whether overall market sentiment is good or bad. If the FTSE is up, good indication that generally, investors feeling bullish, the markets overall are higher. If the FTSE's up, oftentimes you'll see the big markets on Wall Street up, and the big benchmarks in Europe up as well. As I've said here, probably these days it's been, slightly replaced by the Euro stocks, which is the biggest companies within Europe, or maybe just Germany's DAX. Obviously, Germany's got a bigger economy than the UK, and obviously Europe as a whole is the biggest economy in the world. So it is somewhat more important fundamentally, but obviously London is still one of the two major financial centres in the world. So that by itself makes the FTSE important. And as I mentioned here, it's the performance of the largest 100 companies on the London Stock Exchange. But it's important to note that it's not just UK-based companies listed on the London Stock Exchange. The LSE attracts some of the hottest and biggest new global IPOs. So for that very reason, there's some huge companies listed on the FTSE, and so it's, again, an important one to watch. Just as a sort of by the by, what's FTSE mean? Well, it stands for the Financial Times Stock Index, Stock Exchange, sorry, but worth knowing that it's now owned by the London Stock Exchange, which is in fact listed on the FTSE 100 as one of those top 100 companies, but no longer the FT newspaper, which as it stands is owned by a Japanese firm. So the shares are chosen every quarter, so normally two companies that have performed the worst, 2 or 3 companies that perform the worst, or have lost the most market cap, I suppose, might be replaced by 3 other companies that have gained enough market capitalization. So there's a certain free flow here in terms of the shares, but there are a few that have been on it since the get-go. So the constituents of the index are weighted by market cap. So what does that mean? Basically just that the larger shares, particularly Royal Dutch Shell, BP, formerly some of the big banks, still to a large degree, have the biggest influence on the market. So, if you're comparing shares of, in this list, you can see on the side here, if Admiral Insurance, if their shares go up 5% and shares of BP go up 5%, the FTSE is going to be a lot more influenced by what BP is doing than it is Admiral Insurance. This is how the price is derived. I mean, it's not like you have to do it yourself, obviously. It's all perfectly calculated for you all over the internet and on the LCG Trader platform, but just good to know that it's really just that market capitalization divided by this index divisor number. You can find that index divisor number. They provide, the London Stock Exchange provide it. But how do you get that market capitalization number? Well, the price of the stock, price of the shares times the number of shares and times that free float adjustment factor. So again, nice to know what you're trading, but not like you actually have to do the maths yourself, luckily. Another little sort of side note is that it started in 1984 and they just set that original price at 1,000. So it's not like it's, if you're wondering why is the FTSE not just all the share prices of the 100 companies and then maybe divided by 100, well, because it started with that original value of 1,000 in 1984 and obviously it's grown since then about sevenfold. There are actually 101 constituents, so really it's the FTSE 101, but in a way it's not, because Royal Dutch Shell is listed twice with both A and B shares, but it's a good indication as to how huge a company that is, that it has the two listed on there. So talked before about the importance of certain shares was doing so just then. Royal Dutch Shell right at the top there in terms of its huge influence that it has over the FTSE. I thought this was quite an interesting table that was provided that found online, because there are a few companies that are significant within the UK, but may in fact not be part of the FTSE 100. So for example, WorldPay, you can see down there at the bottom, they choose to remain, I believe, still on the AIM smaller index, which most companies like to be part of the FTSE 100 because particularly pension funds and things, they will buy shares as part of the index, or they'll try and track the index in some of their portfolios. So naturally, just being part of a big index like the FTSE 100 creates buying interest for your shares. But you get the occasional, obviously Banco Santander is a Spanish firm, but it has large British operations. So these top 30 companies, so I chose 30 just because it makes it sort of comparable with the Dow Jones, the industrial average in the US, which has only 30. Obviously the FTSE has 100. As I said, those ones at the in the bottom half of the index, there's a bit more variable in terms of whether they actually stay in the FTSE 100 or maybe they drop down to the FTSE 250, which is the next 250 biggest firms listed in the UK, but there's a top 30 or so that rarely drop out, and particularly those top 10. And yeah, just worth noting before I move on is that you can see on the right hand column here we've got market cap, so you can see that both Royal Dutch Shell, HSBC, BP, their market cap is absolutely huge, even compared to some of these firms down the bottom here. Many multiples in terms of the value of their shares. So this was these were some good infographics I picked up from iShares.com, which obviously is an index provider, an ETF provider rather. But it quite neatly shows some of the characteristics of the FTSE 100. FTSE 100 company by revenue as of 2017, well, most of it from the UK, as you'd expect, but actually 25%, a quarter of it from North America, 22.7%, again, and almost another quarter of it from Europe, and then 15% from the rest of the world. So you can see that you can't just think, well, the UK economy is doing well or the UK economy is doing badly, hence I should buy or sell the FTSE 100. It's a very global index. As I said, it has big top international firms, some of which are even based overseas, but even if they're based in the UK, A lot of them have lots of foreign earnings. And then the other thing here was the top 5 sectors. So these are the things, as a group, which will drive the index back and forth the most. So if there is a massive rally taking place in the oil price, then these oil and gas companies tend to do well because obviously they can make more selling their oil products. So 15+% of the FTSE 100 made up of oil and gas firms. Generally, the FTSE 100 is going to be benefiting from higher oil prices. Now, it's only 15%. If there are other negative factors driving stock markets, then that may cause a slight outperformance if the oil price is going up at the same time, while these other negative factors maybe dominate. So you could get a down period in global markets where the FTSE outperforms because of higher oil prices, or likewise maybe overall markets are heading higher, but oil, say in a soft patch, that would dampen the performance of the FTSE. Likewise with banks, which have had a bit of a torrid time since the financial crisis. Everyone's been trying to bottom pick the banks, waiting for that period in which interest rates start to rise again to more normal levels, and they can start making even more money, but it hasn't quite happened yet. But obviously they are a big part of the FTSE. And then personal consumer good, household goods, I mean, that's sort of normal enough. More healthcare, again, more reflective of the domestic economy there, although healthcare does include some of the giant pharmaceutical companies that have big presence overseas as well. And then basic resources, which is not as dominant as it once was, actually probably more dominant in the FTSE 250 or some of the smaller cap indices. There was a certain period when a lot of mining was taking place in Africa and Australia. Those companies were generally choosing to list in London, less so these days after quite a few bankruptcies and a bit of a tough time for the sector, but still a big factor. So if you see copper prices heading higher, that can obviously benefit this particular sector, the basic resources, and that can also drive the overall FTSE 100, depending on the other factors that are, depending on the other news flow. So for those of you who attended the webinar we did on the Dow, similar information here, but it does apply for most of the major indices. I've varied it up a little bit, but there's two kind of approaches that you can take when you're trading the FTSE or as an index. Obviously, you can take the top-down approach, which tends to focus on more the big picture macro environment. So that would be things like the domestic UK and global economy, and obviously we see there that the performance of trade partners like the US and Europe is going to be very important. So if we see Europe doing badly, that will be a negative thing for the FTSE 100. It's not like, well, Europe does badly, they will get the benefits. As far as the FTSE 100, not so much. And I would say to a large extent for the UK economy as well. Europe being one of the biggest trading partners of the UK, you want to see Europe doing well for the UK to do well too. Monetary policy, obviously it's the Bank of England driving that. We'll talk a bit more about the pound in a minute. The performance of the different sectors and industries, as I mentioned before, massive rally in oil price, maybe, right before the financial crisis, obviously banks are doing very well. That helps the index. Is there a commodity crash going on? That would be a negative in terms of those, the basic resource sector. Then there's, you've got to look at how the bond market is doing. If bond yields are rising and you get more return on a bond, then you're likely to get investing in UK companies and receiving dividends, then actually that makes the FTSE relatively less attractive. And it's particularly important to look at the FTSE, which is obviously denominated in pounds, versus UK gilts. And then I mentioned already a fair bit here, but commodity prices, and just about, I think last time I looked on, based on North Sea oil, the UK is still a net exporter of crude. probably is fairly balanced actually these days. So not an outright beneficiary, but not a massive boon for the country if oil prices drop as far as company earnings. And then the bottom up is just looking at these things like earnings growth, financial ratios, including the PE ratio, obviously. And this one that I've put in this chart on the side here, which looks quite groovy, I think, is the CAPE valuation. So it's a sort of an alternative to the PE, if you like. But you can see that black line in the middle in terms of the value of the FTSE 100 since it was constructed. And where we sit at the moment, this chart's slightly out of date, but you can see we sit roughly in the middle. So even though the index is sitting near record highs as we speak, still on this kind of basis of historical valuation, we're neither in a bubble or a depression. So we're kind of sitting right in the middle there. So based on the CAPE valuation, the FTSE could still have further to go. And then, as I've mentioned a few times here, just the effect of the pound. This is the chart that pulled up from Bloomberg. Generally, there is an inverse relationship, and it just is because international firms generating overseas profits, by definition, will earn more if they're converting back those overseas profits into a weaker pound. So all of those, for example, euros will be worth more pounds if the pound is weaker. So then when they're advertising their profits in pounds, they get more pounds for every euro they've made overseas, for example. And so you can see quite straightforwardly from this chart, massive crash during the Brexit vote in the pound, little bit of an initial worry for the FTSE 100, but since then people have just been factoring in that weaker pound. And you can see it's not super straightforward, that the pound has been kind of basing out, but the FTSE 100 has still been managing to move higher. So there is a relationship there, but it's the value of the British pound is not the sole determinant of the value of the FTSE 100. I would say it's more along the lines, if we get a kind of dramatic shift in the value of the pound, like we did in Brexit, that's when you have to readjust for the FTSE. But if it's a matter of the pound moving from 130 to 135 even, it's not that material. So we'll just jump over to the LCG Trader platform. Let's pull that up now. So here at the top, I can see I've already got the UK 100 highlighted. So this is the UK 100 index here. If you want to find it on the platform, it is listed as one of the most popular markets under the watch lists. It's also under I've got these lists a bit, if I get rid of that wall, go under indices, UK indices, there you see there's the UK 100, and then the September contract, obviously we're approaching, it's X'd out for the moment, not quite sure, we're not actually close to September yet, so we're not close to expiry. I'm not quite sure whether that is, but this is typically, you can see the price is moving. You have the option of trading that spot contract or the futures price, which will expire according to the name of it, obviously in this case September. If you want to get a little bit more information about the index itself, just click on here, you can expand it. Obviously this is where you can trade from, buy and sell. This little I button will give you some more indication about what, the fact that it's quoted in British pounds. So obviously if your account's in dollars or euros or something else, you've got to factor in the fact that this is going to be shifting around in pounds. So you've got a slight exchange rate consideration if you are trading the FTSE from overseas. Gives you your market hours there, your lot size. So basically if you're trading one lot in CFDs of the UK 100, it'll be 10 times the index value. So one lot of the FTSE, when it's valued at 7,000, your contract is worth £70,000. I hope that makes sense. And then you know, further down here, you've got the costs of holding the position overnight. Spreads are very tight on the FTSE. I'll show you that shortly. But do consider, if you're considering a really long-term position, you know, this would start to be your main consideration versus that short-term consideration of the spread, which makes it very conductive to day trading, but less so when you've got this funding over a very long stretch of time. And just to show you that spread here, so it stands here. If I just pull up the index here, you can see that at the moment we've got a spread of just 1 point between that's the low and the high of the day, and obviously down here we've got the sell and the buy price, and you can see it's different, 74 to 75. Just 1 point difference is your cost of transaction. So, you know, say if you're buying the index, you're down that 1 point. If you buy one lot, you're going to be down that £10. You have to make that back. Everything else on top is yours. So I haven't actually been checking for questions. Yep, good point by David. Is both HSBC and Stanchart, both Hong Kong companies, but British owned. So yeah, there's a lot of that going on in the FTSE, where they are in essence foreign companies, but owned by the British, and obviously have a lot of earnings that take place in Asia. So you could argue that HSBC and Standard Chartered, for example, more affected by what's happening in the Chinese economy than it is what's happening in the British economy. You know, that's a big source of their earning growth for the time being. Good stuff. I'm going to leave it there just so it doesn't drag on too long. I hope that was helpful for everyone. Obviously, not going hugely in depth in terms of trading strategies, but you know, just providing some index on the kind of markets and products that you're trading, giving a little bit of insight as to the drivers, and you can have that all into consideration when you're considering your trades. Good stuff. Thank you, everyone. Much appreciated. Jasper signing out.